Okay, so we have returned for another session. This will be a little bit different than the normal session because we have a lot to go over in terms of we need to review some of the problems and the questions that have been asked in the last two exercises. And so for that reason, I want to clearly go over some of my reflections and some of my concerns about the answers. The good news, of course, is that I think everybody did their homework, okay? And for the first time, I thought that was unbelievable. And I was really proud of all of you that you're now taking this whole series of classes much more seriously. We're now in communication almost every day, and for that reason you're certainly welcome to write to me or to contact me through Skype or to send me an email or send me a message through Google Classroom or whatever. Some of you have a few aches and pains with Google Classroom. Some of you, they did not accept your email address, and for that reason there's a little bit of a crisis going on there, and so you have to send me a new email address. I don't know why they refuse to accept your email address. Maybe you've entered that email address already with Google Classroom and they don't want to accept the same address. I'm not too sure. But the bottom line is that we need to move forward, and it is also, it seems, developing that the BUV, the university here, will be closed down. I think after Monday, that for health reasons, they don't want me to come to the campus and to prepare these classes, these videos. And so what I'm going to be doing starting next week is I'm going to be trying to film using my laptop and trying to basically cover the same material and send out handouts to you through Google Classroom. I don't get the impression, I'm just reflecting on what would the problems be that I will face in trying to change the location. I'm not too sure if there's a big problem. Probably I won't be able to stick in that little introduction of economics made simple, which is kind of a cute little entrance. But other than that, I think filming off my laptop directly rather than using a camera is not really a big problem. So I'm hoping to continue this starting next week. Okay, so first of all, I want to discuss some of the problems that I felt were not really being dealt with in your answers. And so I think that it's probably a good idea that I go over some of the points that I was not 100% excited about, or I didn't feel that you gave your best answer. Certainly in things related to the increasing returns to scale, constant returns to scale, almost none of you gave me the practical example that I asked for. And I asked for, something like, such as the increasing returns to scale, which is another way of saying, economies of scale. I gave you the example of the car factory, and I was expecting you to continue by giving me some practical examples of constant returns to scale as well as decreasing returns to scale. And I didn't really get that, to be honest. I mean, you could have Googled it. I mean, it's not that difficult for you to do it. If you didn't have an idea or you couldn't think of an example of what that might be. So I just want to go over some of the points that I think that you should really have mentioned. And some of you sort of were a bit confused as to, what is the purpose, of the whole concept of returns to scale, and how do companies in reality, how do they use this information for their benefit? And really it's got a lot to do with efficiency and how it will increase with increased factors of production. So if you actually get more factors of production like land, labor, capital, and managerial skill, will your production increase more than the percentage of increase in factors of production. And so that's kind of important for businesses or government policy makers, and it tells businesses a bit about the optimal production levels that they should use when actually producing, units of production. So just as a couple of examples, I thought that I should just take out of the sky. I mean, the first one we've already given you free of charge, where I talked about factories and car factories, and that, I said to you that, it's the reason why companies tend to become larger, and they want to produce more so that they can cut the costs per unit of production. And if you remember the graph, the U-shaped average cost curve, that should have been pretty easy, where as the level of production increases, the cost per units go down. But how about in constant returns? Okay, and you're going to find that with really very small businesses, and I looked up in a few of my books, and one of them mentioned a car wash, and they said that a car wash has constant returns to scale because if, let's say, you had 1 unit of land where you were going to do the work, and then you had 2 workers who were washing the car, would you actually be able to wash that car more effectively by having 4 workers or a bigger piece of land to actually wash that car? And the argument that they're giving is probably not, and for that reason that would be a constant returns to scale. Certainly when you're thinking about when you're having increasing economies of scale, you often have a small number of large firms because, as I said to you before, there is an advantage in large production. And in the books they give examples of airlines like Boeing, for example, or Airbus, or car production like Toyota, examples that I've already given. Certainly it would be true to say that if you were dealing with a situation where you were having decreasing returns to scale, then that normally suggests that it's becoming more difficult as time goes on to receive, let's say, the benefits to what you're looking for with time. And the example that they gave was researching for natural resources. And so let's say an oil company like Shell or BP or any other oil company, that the longer that they are kind of looking for oil, you will find that most of the easy sort of bits of oil, which are right at the surface, have actually already been mined, you might say, or already been harvested or have been sucked out of the ground. And that with time, with more resources and more money being spent and more equipment and more high technology, you're starting to find that it's becoming more and more difficult and more expensive to find economical supplies of oil in the future. And so that would be an example. Companies that are involved with looking for natural resources, that they are definitely with time going to find it more and more difficult. I mean, if you remember when we had that catastrophe about 5 years ago in the Caribbean, where they suddenly found that there was oil leaking from the ground of the Caribbean, and this was due to British Petroleum, who had been mining 2 kilometers down to the ground, to the surface of the water, and then another 2 kilometers further down. So they had actually been drilling 2 kilometers, they had been sticking a pipe into the ground 2 kilometers deeper than the deepest part of the sea. So you can imagine that is unbelievable. That's like 4 kilometers of mining that they're going down into the sea and into the ground below the surface of the water to find, you know, supplies of oil that, you know, they're trying to make a profit from, and it's becoming more and more expensive. So that would be a fairly good example of where, you know, the more money that you're spending, you're probably getting less and less return from your investment. Okay? And I mean, we often refer to that as like a form of diseconomies of scale. So you should remember that as the rightward shift of the U-shaped average cost curve. Just want to go over a couple of questions that had been asked. One of the questions that was asked related to the whole issue about the shutdown point. And the question was, how can a company prepare for the possibility of a shutdown point? And if you remember from the handout that you received last week, you can see that we dealt with this issue here, the decision of whether to produce or not to produce in the short run. And on page 3, you can see that, you know, there are certain levels of production where they refer to the point where the company has to shut down because the level of revenue does not actually cover the variable costs of production. And well, that's a good question. You know, how can a company prepare for the possibility of knowing the shutdown point? I mean, for one, certainly when you're trying to borrow money from the bank, a lot of companies will have to tell you where is the shutdown point. So for example, you know, if you're making, I don't know, rolls of toilet paper, you know, you may have to have a certain amount of production in order to make a profit. And if you go below a certain level, then you know, you could say, well, if I only produce 1,000 rolls of toilet paper, or I can only sell 1,000 rolls of toilet paper per day, then that would have to be the shutdown price. And that's important information because a lot of banks won't lend you money unless they see exactly what is the picture of your enterprise that you're trying to get into. So clearly, you need to provide that information to banks, and you need to provide them with the information as to you know, what level of production will you have to shut down. We're not talking about producing zero, where, you know, you could be producing maybe 1 million units of production, but that's not enough to be profitable. And so that would be an example. How do you avoid that? Well, there isn't any way, you know, because there are exogenous factors that can affect you know, your business, and, you know, suddenly there could be a recession, or there could be a war or a virus like we have at the moment. Although ironically, the virus would actually probably increase the demand for toilet paper. As if you've been watching the YouTube channel, just type in the words toilet paper and virus, and you're going to see lots of films of YouTube videos of American consumers hitting each other and fighting over rolls of toilet paper. So this is kind of an interesting phenomena. But what we could say is that you know, you need to know exactly at what point of production is it no longer economically feasible. And just a certain amount of knowledge of your, you know, knowing the market, having a little bit of understanding as to how you could increase your market share, or, you know, certainly you need to get your marketing department of your company operating to increase your level of publicity and be maybe more competitive in pricing, or whatever. Maybe you need to advertise. These are different strategies to avoid completely shutting down. But certainly in terms of knowing your shutdown point, it's just basically a question of knowledge. It's just a mathematical issue that you need to know the costs of production and how many rolls of toilet paper does it require for you to break even. He's saying, can managers do things to make the shutdown less likely if they know where the break-even point is? Well, that's a good question, and I'm not too sure what the answer is, really. I'm not too sure what managers could do other than to operate the company in a way that will, promote their industry or promote their company, and to sort of hope that, you don't have an exogenous issue like a depression or a war or a virus or whatever, so that you can, be efficient and you can produce as well as you can. So what we're going to do now, after looking at some of the problems of the answers, which were the lack of examples in your returns to scale, and after answering a couple of questions that some of you have actually written, I'm going to go into the next unit, which is really about business objectives, okay? And I'm going to be sending this one out tomorrow so that you will be receiving it. It's called Business Objectives, and it basically tells us exactly, what are the main objectives of, any business in today's competitive sort of environment. And I was looking through some old past papers, and one of the questions was, like, what is the number one priority in terms of objectives for any business? And my first reaction was to maximize profit, and that was wrong. They told me that the real objective is survival, and that's certainly true, that that you need to survive, I suppose, before you can maximize your profit. So you need to know what are the different strategies to avoid, going bankrupt or losing all your money or losing the money of the shareholders. And for that reason, that is certainly one of the issues that you need to think about. But I'd say that 99% of economists, their first reaction to that question will be profit maximization. And this is, you might say, the ugly side of economics, because it really shows how potentially selfish or the ideals of selfishness are promoted in economics. The idea that you're not really that concerned about society in general. What you're really concerned with is making as much profit as possible, and that would mean all sorts of consequences, such as externalizing the externalities, like not wanting to pay your share pollution. There's a lot of criticism of Apple and Amazon.com that they don't pay their taxes, and so some people would say, well, that's very wise of them, because one of the objectives of the company, the number one objective, is to maximize your profit. So if you can avoid paying taxes in whatever way you can, you might actually, operate from some small island in the Caribbean in order to avoid paying your taxes. And, some economists will praise those business people and say, wow, well done, because that's your objective. Your job as a manager or whatever is to satisfy the shareholders, and the shareholders are basically interested in maximizing their profits. So economists would love to believe that owners and managers of businesses would be exclusively profit maximizers, as this would reinforce their logic that we are all motivated in a rational and self-centered manner. But in the real world, owners, workers, and consumers do not always act rationally, and they do not always follow the laws of economics. And that's very true. There's a big section in the textbook about rationality, and can we really analyze business objectives when we don't really know what the real behavior of consumers and firms are. Like, not only do consumers not always act rationally, you could argue that firms don't act rationally, or at least they don't follow the laws written out by economic professors, in their PhDs. And so this is what they would refer to as being irrational, is if you don't actually follow the laws of economics. So firms may pursue a variety of objectives that may complement profit maximization, such as revenue maximization and sales maximization, which is kind of somewhat similar. The best example of this was Amazon.com, okay? The CEO of Amazon, a guy called Jeff Bezos, he spent the first 20 years of the company's existence breaking even. And I can tell you, he got the people who were working with him really, really angry, because he felt that there was huge potential for money making in this operation, and he seemed to be not that interested in money. And of course, he's the richest man today, so obviously he was interested in making money, but he had a strategy of making money which was different than many others. So what he was trying to do is he was trying to maximize the number of consumers and get consumers a bit addicted to the benefits of Amazon.com, like sort of same-day delivery of your parcels, or when you're going shopping, to sort of always use Amazon's webpage, and that you'll always get a guarantee, no matter what your problem is with the product, that they will always take it back and give you your money back, etc., etc. And so they believe that somehow if you could make the consumer's life easy in shopping on the internet and overcome their fear of using credit cards and that sort of thing, that you would actually be able to get a lot of return customers. And that's what his intention was, that he wanted to plow back all the profits back into the company, make it bigger and bigger, larger warehouses, using more and more technology to get the company moving forward, and to kind of forget about profit, at least in the short run. So profits were not made and revenues were maximized. Everything was done to increase the number of loyal customers to Amazon. And if that meant being price aggressive and seeking market domination, then that was the strategy, even after going public or issuing an IPO. And that's kind of a fancy economics expression for putting your company up on the stock market. And this was not right away. Jeff Bezos waited for a long time before he did that, but he decided that he needed even more money to help grow his company. So he decided to put his company on the New York Stock Exchange, which has its advantages, because you can raise money quite easily, and the opportunity cost of investment means that it's a lot cheaper to sell shares than it is to borrow money from the bank at, let's say, 10% or 20% interest. And so he decided that he was going to allow a lot of people to invest in Amazon, but he wasn't going to be giving any dividends, which is like a check in the mail that he would give to encourage people to hold on to their shares. And he wasn't going to be allowing the value of the shares to go up dramatically as the profit went up of the company. And a lot of investors were criticizing him and feeling like, hey, hang on a minute. The reason why I'm investing in Amazon is not because I love your company, but because I want to make some money. And for that reason, he had a big problem in fighting off during the annual general meeting, the AGM, fighting off a lot of the shareholders who were demanding a different strategy, a more profit maximizing strategy, to ensure that there would be regular income flows for the shareholders. So everything was done to increase the number of loyal customers, and as I say, even after going public and getting themselves onto the stock market, that things were not really going all that well for the company, because Jeff Bezos believed in trying to maximize growth and he was trying to plow back all the profits. And eventually, when Amazon had successfully destroyed the competition, which is really what they did. I mean, Amazon started as a bookshop and just selling books. And so a lot of bookshops closed because, the margins that the profit margins that Amazon was making was maybe 1 or 2%. And to survive by having a bookshop where you could sit down and you could sort of look at the books and you could feel the books, etc., you need to make at least 10, 15, 20% profit. And so clearly, a lot of people who were trying to buy books at the cheapest price possible, it was just so much more convenient to actually buy the books online, and when they were getting their delivery really quick, then they knew that they had a winner on their hands. And so Jeff Bezos today has become one of the richest men in the world. Okay, I think he's number 2 or number 1 or something. His strategy of short-run revenue maximization and long-run profit maximization seem to have worked. Okay, so, did he benefit, the whole society? He certainly didn't. He probably reduced the amount of employment in a lot of the businesses because many of the businesses went bankrupt because they could not compete with the lower prices of Amazon.com. And so a lot of little bookshops and a lot of businesses had no choice but to close. So the question of what motivates a firm in its actions can only be answered if there is a clear understanding of who controls the decision-making process. This control is likely to lie with one or more of the firm's stakeholders. Okay, so a stakeholder is anybody who has really an interest in the success of the company. So certainly Jeff Bezos would have, and he was really it was a very kind of hierarchical type of business model where he was making almost all the decisions. He wasn't very interested in sharing out the decision. I mean, he was quite a clever guy, but the bottom line was that, he was the person who made most of the decisions, and most of those decisions meant that he became a rich person and other people, became a bit less rich. So some of these companies, may be satisfied with this idea of sales maximization or revenue maximization, particularly if the owners feel comfortable with normal profits and consider that sales volume is a measure of the size of the firm. So sometimes they're okay with that. They want to tell the world that they have the greatest number of sales. Now, whether that means profit doesn't mean anything at all. I mean, it just means that they're actually, selling a lot of products. And if you're not making any money from it, then the obvious question is, why are you doing it? And this is a model, a business model that is often in the news because people sort of look at something like Facebook and say, well, where is the money involved? Where is the profit? Because, Facebook doesn't actually charge you any money to use Facebook. It's free, and therefore, what is the mechanism by which you're going to make money? So Facebook, for example, they make money through advertising, but this is a common problem that you kind of offer things free to people, but somehow indirectly you're able to make money elsewhere. Satisficing is one of those kind of cute terms which I think somebody invented in their office in New York one day. And that really refers to the idea that you're doing just enough so that your boss doesn't come and fire you or crack your head in two or whatever. And so it's really kind of minimizing your effort. And unfortunately, that is a business objective for a lot of kind of, you might say, less entrepreneurial, or you might say lazy companies who want to survive, who want to make money, but they don't really want to work really super hard. They're not that hungry, and therefore they are quite satisfied with, let's say, normal profits. They're not going to make the effort necessary through maybe research and development to make super normal profits. They're just saying, well, normal profits are okay. And so that's really what we're talking about, satisficing. We also make reference to perks. that there's a lot of companies that are just interested in what are all the, like the, you know, maybe a company car or free private education for your children. A lot of these are kind of objectives, business objectives, which, you know, is not cynical, it's very truthful, and it's one of the complex questions in business, is how to motivate people and how to get people, rather than just looking at their own personal situation, how can they, you know, somehow think like the owner. In other words, trying to make the manager have a CEO's brain, because the CEO, he's looking to put money in his pocket, and the managers are just paid a salary. And therefore, you know, the obvious question would be, why should I break my butt to make you, another person, rich? And it's a good question, you know, like, why should we be working so hard and taking personal risks, etc., if really I'm not the one to benefit from all this hard work and risk taking? It's the owner. So the owner needs to think, maybe, how can I get the managers to think a bit like me? And this is where things like profit sharing might come out, or things like stock sharing, and paying people through stocks rather than salaries, so that you kind of feel like you are a part owner of the company, and if the company does well, then the share price will increase, and the share price increases, then you will benefit from it. So this is some of the tricks that owners can do to somehow change the objectives of business and get it to be more profit maximizing, even though a lot of managers don't understand why they need to work so hard to make somebody else to be a wealthy person. So we've got two questions at the end, okay? It says, why are business objectives so different depending on the business? Okay, so that's a trick question in some ways, okay? So you need to sort of refer to different types of businesses, and how will that mean that their objectives might be different, maybe larger firms or smaller firms, or if you have a small coffee shop, would the objectives be different? Or if it was like a co-op, you know, where, you know, you don't really have employees or workers, but you actually have kind of company shareholders, really, you know, everybody has a piece of the pie, and therefore, in theory, it's a lot more democratic than any form of private sector enterprise. And then second of all, in your opinion, which business objective is the most important in Vietnam today? And that's a pretty good question, and that should use a little bit of your personal knowledge. You know, I'm not really one who just wants, who believes that, you know, you've got an empty head in, you know, and that you're learning all these new words and new concepts, and, you know, I'm kind of pouring information into an empty mind. I think you need, in your learning process, you need to share with everybody your personal experiences in Vietnam. And that's why, as much as possible, I try to get you to answer questions related to you know, Vietnam or your personal experiences. And if you remember the 4-paragraph strategy of answering essay questions, you know, the Cambridge Examiner wants you to share in your personal experience. We know that you have millions of experiences that may, you know, may be useful for us to learn. It's not just for me to teach, but for me to learn as well from your experiences. How has this whole issue of business objectives played out? Have you worked maybe as a summer job in a company where the objectives seem to be a little bit different, were maybe less democratic or more democratic, or whatever? So that's it for this week. You know, I want you to hand in this work by next Thursday, okay, by next Thursday, because things are changing. And BUV is changing. We're supposed to be out of this building. The government seems to be more and more serious about their concern for the health of the Vietnamese people, and for that reason, they're following the lead of many other countries that are virtually closing down, their country. I mean, Canada, where I come from, the Prime Minister even got on television the other day and told all Canadians to return to the mothership, he said, and to the motherland, because he feels that Canadians need to be protected by the warm arm of their mother country. And so I thought that was kind of funny, really, but things seem to be getting more serious, Vietnam seems to be one of the few countries that really have their act together, and they're doing quite well because very few people are sick. I think it's only about 65 people who are sick, and most of those people seem to be getting better after a while. I think we've had very few deaths from this virus, so I think that whatever the Ministry of Health is doing, they're doing a good job. They're keeping us safe and they're keeping us alive. So I'm not going to disagree with any of their recommendations. But what it means probably is the following week, we are going to have to operate from my laptop probably. I'm going to be teaching through the laptop rather than through this camera. And hopefully we can continue, through the internet, we can continue with Google Classroom. I find Google Classroom super handy, super helpful, because it helps me to be better organized. Just imagine all these essays and homework coming in from all directions, some people sending them to me by email, some by Google Documents or whatever, and some by Google Classroom. So what I want is that everybody gets onto Google Classroom. If you haven't been registered, send me a different email address, because maybe there's a problem with your old email address. I want everybody working through Google Classroom starting now. Okay, so keep safe. I worry about all of you, and hopefully we will all be okay until next week. So bye-bye for now. Bye.